You have heard this pitch at every startup event, in every founder WhatsApp group. Someone says it. Just set up in Dubai, pay zero tax. A holding company in the UAE. No income tax, no capital gains tax, a golden visa, and sunshine. It sounds like the perfect escape hatch. I am a chartered accountant who works with cross border founders every week, and I get asked about the Dubai structure almost every time. Here is the honest answer. A UAE holding company is a genuinely powerful tool for the right founder and an expensive trap for the wrong one. The difference comes down to a few things nobody mentions in that pitch. Let me start with what a UAE holding company actually is. It is simply a company set up in the UAE, either on the mainland or inside one of the free zones. The names you will hear are DIFC, ADGM, DMCC, IFZA. That sits on top of or alongside your operating businesses. Its job is to hold things, shares in your subsidiaries, your intellectual property, or your investments. It is the parent at the top of the structure, just located in the Emirates, instead of India, Singapore, or Delaware. So why do founders genuinely want one? There are real reasons, not just hype. The UAE has no personal income tax and no capital gains tax on individuals. The dirham is pegged to the US dollar, so there is no currency surprise. It sits at the center of the Middle East and the wider GCC. So if your customers or your expansion are in that region, a UAE base puts you next to them. The banking is global, the regulators are business friendly, and a free zone company can come with residence visas for the founders and their families. For a founder who is actually moving to Dubai or genuinely building across the Middle East, those are not gimmicks. They are solid commercial reasons. But notice what I just did. Every one of those reasons is about where you and your business actually are. None of them is, and it makes your India business tax-free by magic. That distinction is the whole video, because two things have changed, and most of the people giving you the Dubai pitch have not updated their script. The first is that the zero tax era is over. The UAE brought in a corporate tax in 2023. The second, and far more dangerous for an Indian founder, is an Indian rule that can reach across the border and tax your Dubai company as if it was sitting in Mumbai. Let me walk through both. Take the tax first. The zero tax Dubai line is simply out of date. For financial years starting on or after the 1st of June 2023, the UAE introduced a federal corporate tax. The rate is 9% on taxable profit above roughly 375,000 AED, which is about 85 lakh rupees, and 0% below that. So Dubai is no longer a no tax jurisdiction. It is a low tax one, with a real tax regime, registration, and filings. Now the free zones. This is where the 0% rate survives, but with conditions founders love to skip. A free zone company can still pay 0% corporate tax, but only as a qualifying free zone person, on qualifying income, and only with real substance in the UAE, a real office, qualified people actually working there, and the core activity genuinely carried on in the Emirates. A nameplate and a PO box do not qualify, and non-qualifying income is taxed at 9% anyway. Here is the part that actually catches Indian founders, and it has nothing to do with UAE law. It is an Indian rule called place of effective management. India does not only look at where your company is registered, it looks at where the key management and commercial decisions are really made. Set up a holding company in Dubai, but sit in Mumbai, making every important decision over email and video call. And India can treat that Dubai company as an Indian tax resident, taxed in India on its worldwide income. Your zero tax Dubai structure quietly becomes a fully taxed Indian one. There is a carve out for genuinely small companies, turnover at or below 50 crore rupees a year. But above that, this is the single biggest risk in the whole structure. The India-UAE tax treaty can relieve double taxation, but only for a company genuinely resident in the UAE, incorporated there and managed and controlled wholly from there. The treaty also carries its own anti-abuse rule. No benefits where main purpose of creating the entity was to obtain them, or where it has no bona fide business activity. Substance is the whole game. One more piece founders miss: FEMA. You cannot just wire money from India to a new Dubai company. A resident individual invests overseas under the liberalized remittance scheme, up to 250,000 US dollars a year, into an operating entity. An Indian company invests through the overseas direct investment route under the Overseas Investment Rules of 2022. And real estate activity entities are off limits without approval. So, who should do this? Founders genuinely centered on the Middle East, or actually relocating to the UAE with real substance behind them? Who should not? An India-centric business run by a founder living in India, hoping Dubai makes Indian tax disappear. It never did. If you are weighing Dubai against Singapore or staying in India, the entity comparison tool and the FEMA compliance checklist are linked below. To pressure test your own structure, book a strategy session and subscribe for a weekly founder-focused breakdown.